Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
All right, if you're in a Canadian partnership, the term T1513 has probably crossed your desk and maybe sent a little shiver down your spine. It sounds complicated, right? Well, it doesn't have to be. We're going to break it all down, piece by piece, so you know exactly what you're dealing with. Let's get right into it. Okay, so let's tackle the question that trips everybody up right from the start. We all know partnerships don't actually pay income tax, right? The money just flows through to the partners. So why on earth does the CRA demand a return? What's the point? And here's the big reveal. The T5013, it's not really a tax return. It's an information return. See the difference? Think of it as a roadmap for the CRA. It's how they connect the dots between what the partnership earned and what you, the partner, claim on your personal return. It's all about making sure the numbers line up. Total transparency.
All right, Section 1. Who actually has to file this thing? This is the million-dollar question, so let's dig into the CRA's filing requirements.
Okay, so take a look at this list. If your partnership hits any single one of these criteria, you're on the hook to file. You've got the big money triggers, revenues, expenses, and assets. But, and this is important, it's not just about the cash flow. The type of partners you have, or if your partnership is part of a bigger structure, can automatically mean you have to file. And then there's the ultimate rule. You file if the CRA tells you to. Simple as that. Let's pause on that $2 million rule for a second, because this is a huge stumbling block for people. We're talking about the absolute value of your revenues plus your expenses. You don't subtract them to find your profit. Nope, you add the two big numbers together. This is so important, and it catches a ton of people off guard. Check out this example. It makes it crystal clear. So this business on paper has a net income of just $250,000. Not huge, right? But for the T5013, we don't care about that. We take their revenue, $1.5 million, and we add their expenses, $1.25 million, and what do you get? $2.75 million. Boom! They are way over that $2 million line. They absolutely have to file. But what if your finances are small, like way below those thresholds? Are you off the hook? Not so fast. The CRA is also looking at how complex your partnership is. If you have a corporation or a trust as a partner, even just one, you're filing. And if your partnership is part of a tiered structure, like a partnership within a partnership, well, that's an automatic filing requirement too. This table is a perfect example of that tiered rule in action. So you've got ABCD Partnership. Its members are an individual named Sawyer and another partnership called Phoebe Properties. Because ABCD has a partnership as a partner, it has to file. But here's the kicker, the real domino effect. Phoebe Properties now also has to file its own T5013 simply because it's a partner in another partnership. It doesn't matter what its own income is. So what's the bottom line here? If you're a small, simple partnership, we're talking just individual partners, no corporations, no trusts, and your financials are below those big thresholds, you're usually exempt from filing. That's the main takeaway. But, and there's always a but with taxes, right? Always remember that the CRA can tap you on the shoulder and ask for a return anyway. They always have the final say. Okay, Section 2. You've figured out you need to file. Now what? What exactly are you sending to the CRA? Well, it's not just a single form. It's a whole package. Let's look at the 4 key parts. So the whole return is basically built from 4 main pieces. First, you've got the T5013 fin. That's the big one, the main financial summary for the whole partnership. Then you've got all these schedules. Think of these as the appendices, where you show your math for things like asset depreciation. Third, and this is key for the partners, is the T5013 slip. Every single partner gets one of these, showing their personal slice of the pie. And finally, you bundle it all up with the T5013 sum, which is just a summary page that tells the CRA, hey, here are all the slips we sent out. Yeah, it's really like a big puzzle. Each form is a different piece, and when you put them on together correctly, it gives the CRA a perfectly clear picture of your partnership's finances for the year. No missing pieces. All right, let's talk about something that should get everyone's attention. Deadlines and penalties. You really want to listen up here because the CRA does not mess around with this stuff, and the costs for getting it wrong are steep. Your filing deadline is all about your partner mix. Super simple. If all your partners are individuals, your deadline is March 31st. If they're all corporations, it's 5 months after your fiscal year end. Now, what if you have a mix of both? This is the one that trips people up.
You have to file by whichever date comes first. So if your year end is December 31st, 5 months later is May 31st, but March 31st comes earlier, so that's your deadline. You gotta watch that one closely.
Okay, one small piece of good news. If that due date lands on a weekend or a holiday, you get a little break. The CRA says it's due on the very next business day, so that's nice.
But what happens if you're late? The penalty clock starts ticking immediately, and it starts at $25 per day. And that $25 a day penalty, it comes with a minimum charge, $100. So even if you're just one day late, it's going to cost you at least $100. And that daily charge doesn't stop. It keeps adding up, day after day, for up to 100 days. You do the math, that's a maximum penalty of $2,500. Ouch.
But wait, it gets worse. A lot worse. That penalty we just talked about, it's not per return. The CRA says it can apply to each individual form that's missing. That includes every single T5013 slip for every single partner. So if you have 10 partners and you're late, you could be looking at that $2,500 penalty times 10. The numbers can get astronomical fast.
Okay, last section. Let's complete the puzzle. We've seen why the partnership files, but how does that information actually get from the partnership to your personal tax return?
It's actually a really clear path. First, the partnership does its business. It earns income or has a loss. That all gets bundled into the T1513 return and sent to the CRA. Then the partnership issues you, the partner, your own T1513 slip. That slip is your golden ticket. It has all the numbers you need to fill out your personal T1 or your corporate T2 or your trust's T3 return. And here's the last key concept, and it's called the flow-through principle. Basically, the income keeps its original identity. It's like a label that stays on the money. If the partnership made business income, it's business income for you. If it was a capital gain, it's a capital gain for you. The T5013 makes sure everything stays in its correct bucket, all the way to your final tax return.
So at the end of the day, that T5013 return tells the official story of your business to the CRA. It lays everything out there. Which leaves us with one final, pretty important question for you to think about. Is your bookkeeping good enough to tell that story? Because when it comes to the CRA, you want to make sure your story is accurate, detailed, and, most importantly, on time.